The Intelligent Investor, Benjamin Graham, Introduction. Warren Buffett, in the very first few pages of this book, praises his mentor, Benjamin Graham, about his ability to recall anything that he has learned over his lifetime. So he's saying he has a total recall of everything. He has unending fascination for new knowledge and thirst for new knowledge, and ability to use his current knowledge and apply it to unrelated problems. So, using theories and mental models in one area to another area. With this book, an intellectual framework and a set of analytical tools will be provided for decision making on stock market and stock picking. And the key thing is to keep our emotions from influencing that intellectual framework for us to be successful. Investment return is directly proportional to the market folly. The more the markets are in folly, the more you'll make. But all you need is minimum effort in stock picking. If you overdo, and there's certain line which I hope to discover in this book, if you overdo your effort in stock picking, then the author feels that that may be detrimental to our overall returns. Human psychology has a huge role to play. In stock markets, we see swings from unsustainable optimism, where the stocks are too expensive, everyone's buying at any price, to unjustified pessimism, where the stocks are cheap. A stock is not a ticker symbol, but it is an ownership interest in an actual business. So when you think about it from this lens, you'll never sell a stock once you buy it. So that was a key learning. When you own something, you own it for a long period of time. You don't buy, sell, buy, sell. And when you buy it at a good margin of safety, where you have a fair price that you pay. You're not overpaying so much that when the stock corrects, like let's say 90%, right, you never return back to original. So no matter how exciting the investment seems to be, minimizing the odds of critical errors is critical for keeping the money that we have and building wealth. And he goes on to such an extent to say, hey, your investment will behave in much less important than how you behave. So whatever investment choices you've made is more proportionally related to your behavior than the actual investments themselves. So don't be too clever, you may do worse. This book provides guidance in adoption and execution of investment policy. History repeats in stock markets, so it's important to learn and study the history. Those who do not remember the past are condemned to repeat it. An important technique of dollar cost averaging is quite persuasive for regular monthly purchases of strong common stocks through thick and thin for a long period of time, maybe 10, 20 years. You'll come out strong. Factors that impact the stock market also include Fed policies, interest rates, inflation, bond returns, bankruptcy rate, labor market, unemployment rates, etc. There are two types of investors, a conservative investor and enterprising investor. And both of them may have different percentage splits between stock and bonds. If you're an aggressive enterprising investor, you definitely need to have more time, more interest, more frequent decision making process. You can go higher in this percentage of stock. So you need to define who you are. Are you a defensive, conservative investor or an aggressive, enterprising investor? And based on who you are, the percentage may change of stock and bonds, high quality bonds. If you have a theory on a belief on what industries are going to grow into the future, it helps you narrow down which companies to buy stock. So if you knew back in 1990 that computer industries are going to grow, then you at least have a higher chance of making a good return. But what the author has found is that all obvious growth businesses like the computer business does not translate into obvious profit for investors. So he's saying that during a very long period of time, everyone except IBM failed. So even people who were paid highly for mutual funds or hedge funds, they had very hard time selecting and concentrating their positions on selective industries. And if you pick a bad stock which loses, let's say, 95% of its value, and a lot of those stocks exist today, you will require that same stock to go up a 1900% to come back to the same level, which is almost impossible. So imagine, how often do you see a $30 stock going to 600? It's very rare. But a 95% drop is not rare for a lot of companies. So not losing money is critical. Buying stocks is like buying groceries. Keeping that mindset, you will not sell the grocery that you just bought and buy another one. You'll buy more at a lower price. The book advice is simple portfolio policy, wherein you have a combination of high grade bonds plus diversified list of leading common stocks which any investor should be able to buy. There will be calamities like world wars, recessions, many events that come and go that have a huge significance while you're going through it. But staying put over the long period of time and being ready for like almost a 50% correction, if not even more, and still holding on to your portfolio and not selling them is the key ingredient for success into stock market investments. To sort of summarize this entire introduction, minimize the odds of suffering irreversible losses by margin of safety, paying the right price, picking big leading common stocks that have a good history, maximizing your chances of achieving sustainable gains over a long period of time, not a short bet, and controlling your self-defeating behavior through emotions of selling at a low price and buying at a high price, and then constant buy sell buy sell. You need to keep that in check. And an intelligent investor, which is the name of this book, is an investor more of a character than an IQ. A person whose character is to be patient, to be disciplined in investments, to be buying at the right regular cadence, and has his or her emotions in check, and is eager to learn new things and new developments, has a higher chances of success. Remember, enthusiasm is good everywhere except Wall Street. At Wall Street, enthusiasm invariably leads to disaster. Ensure before you get into stock market that you have at least 1 to 2 years of cash for your spending needs, and then jump in. Bear markets could go anywhere from 4 years to 6 years as well. If not, you should be ready for 8 years. Thanks.